cover. So I hope that as the rest join, they should be able to catch up, or they'll get the recording. So on Monday, we did a bit of an introduction with Nyamolo, and we also went ahead to draft some accounts. We drafted the income statement and the balance sheet. So that was also scheduled for today. So today will also be a sort of a revision class. I hope that should help us reinforce it. And as we do that, I think let me just delve into it. We will start with final accounts, and then finally we will do statement of cash flows. Hopefully time allows. So I guess we can start. And we already know that our final accounts consist of an income statement and a statement of financial position. An income statement basically records your income. So it has your income and expenses. You can also call it your profit and loss account. And the general idea here is that for you to get your profit, right, you're just determining like how much income you've made and how much expenses you've had. Then now what's your profit or your loss? So what goes into your income statement, profit and loss, is basically your income and expenses only. On the other hand, you have your statement of financial position, some sort of typo there. Yeah, so the second one is your statement of financial position, which is also your balance sheet. And this will show you what your assets are and what your liabilities are. The easiest way I have found to explain this, to elaborate on this, is no. Let me explain the time period here. Let me explain the time period here, and then I can actually elaborate what is happening in your balance sheet. So these principles relating to financial accounting were also covered with Nyamolo. So the only thing I want to emphasize for today, which I think would feature in what we are about to draft, is these three. These are the most important ones, but perhaps it could benefit us to just go through these other principles for the purposes of theory, but I trust we are better off with theory. So one concept I would want to elaborate more on is on revenue recognition. And your revenue is you're supposed to recognize your revenue at the time that it is earned. And when you actually earn it is when you invoice your client. Like you've offered some legal services for your client. Let's say you've drafted a contract. You have raised an invoice and invoiced them that you're supposed to pay us, let's say 200K for it. That is when you recognize your revenue. It does not matter that your client will pay you in 2024. It is still your revenue for this year. It is your income for this year, only that it will be paid at a later date. I don't know. Perhaps someone could try to admit. If you can do it, I think that would be easier so that I don't. Yes. Okay. Yeah. So your revenue should be recognized at the time when you raise your invoice. So even if you're paid in 2030, that is income for 2022. Another important concept here is your time period, and Nyamolo already mentioned it. You have specific years. That is why you will find us saying that we are reporting as at 31st December, because that is when your books are closing, so that then all the transactions should be limited to up to 31st, not earlier and not later. And finally, accrual basis. And accrual basis basically comes in where you have now this is for your expenses. You accrue your expenses. You have been charged rent for your premises, but then you have not paid it. You have received the invoice, but then you've not paid it. Let's say that is your December rent. You receive your invoice on the 31st. You've not paid your landlord yet. So you accrue in that, despite the fact that you've not paid for it, that is an income for that year, for December, and it's closing then. So you will expense it even though you have not paid for it. So the fact that then you are you're expensing it without paying it, so that it reflects as something, an obligation that you ought to pay, yeah, that is what we call the accrual basis of accounting. So basically what we will need to do is to differentiate when literal money changes hands and when a transaction occurs, because a transaction can occur without money changing hands. So having said that, then I think I can try to come back to the concept of having the balance sheet. And so we have already said that your income statement has your income and expenses for that year only. But then we have said that also we have a time period. Let's say our year ended on the 31st of December 2021. There are aspects of your business that traverse that period. The fact that 2021 ended in December does not change the fact that you still own your land, you still own your buildings. It does not change the fact that you still have a loan that you need to pay. It does not change the fact that your members have contributed capital. It does not change the fact that there are some customers you already invoiced but they have not paid you, and also there are some suppliers who have invoiced you but you have not paid them yet. So your statement of financial position basically will show you what are our assets. So what do we own? We own our buildings, we own our motor vehicles, we own our cash in the bank, we own our inventory. We sort of own our accounts receivable, because we are still expecting the money to come from our clients. So that is our property, that is your asset. You own it, you have title to it. On the other hand, you could also have an obligation. An obligation means that this is not your money, you owe someone. And that is why when you come to your yes, and that is why this is your template for the balance sheet. Yeah, so you own your land, your property, you own your motor vehicles, you own your furniture, inventory. Inventory is your stock. Inventory is if you're dealing in a business where you deal in goods, then inventory is what you still have with you for sale. And then your trade receivables, that is interchangeably. You can call it receivables, you can trade receivables, accounts receivables, you can call it debtors, however you want to call it. That is the money that your customers have not paid you yet. You've invoiced them, they've not paid you. So that is your money you're expecting back from them. So that is your asset. Prepayments were explained by Nyamolo. So just to recap, prepayment is a good example is your insurance. The policy runs from, let's say, June 2021 to May, to May 2022. But then your year ended in December. So since you are invoiced with one invoice and you paid the entire amount, which is covering until May of 2022, then you must apportion, because that expense, the expense that is relevant for the 2021 year is running from June to December. So the prepayment is the amount that now you've already prepaid from January to May, when that policy is supposed to expire. Your cash is yours. I think we understand that. And that is how you get your assets. Your liabilities are your obligations. They are things that you owe other people. So for example, your capital, that is the share capital that has been contributed by the members. And that is their contribution. It is not the company's money. Remember the concept of separate corporate personality. The company is very different from the owners. Okay, perhaps not even necessarily the company, but even like when you're running a business, you should be able to separate the business from the people, so that if myself, I am Linda. So if I, Linda, contributed capital to Linda Limited, then Linda and Linda Limited are two different people. So if Linda gives Linda Limited money, then that is not Linda Limited's money. So you will recognize the capital because that is the amount that has been contributed by the members. So it is not the business's money, it is someone else's. Retained earnings, perhaps I should have, okay, yeah. So retained earnings are, allow me to just highlight this because I think that I should have started with the income statement. Allow me to highlight that. I'll be back. But then also drawings. Drawings can be money that has been drawn by the owners. So myself, I have a company, I have a firm. Actually, to make it more relatable, I have a law firm. I withdraw money from Linda LLP. So that money is the LLP's money and not mine. And that is why I must be able to deduct it from the capital contribution that I had already made. And then loan, that is obvious, the loan you owe people. So that's your liability, that is your obligation you must discharge. The same for debentures. I think we understand the concept of debentures. And then you also have your liabilities. Now, the trade payables are just the inverse of the trade receivables. So for payables now, these are the expenses you've been invoiced for, but you have not paid. So I gave the example of rent. I've been invoiced for rent. The period has ended on the 31st. I've not paid it yet. So I need to record here so that then I know that I need to pay this. So you can call it trade payables, you can call it accounts payables, you can call it creditors, however you want. That is okay. The accruals, I had mentioned it, so it's basically the same. An accrual is very similar to trade payables, only that trade payables mostly okay. I do not mean to lose you, but so your trade payables are for like your main suppliers, like the main expenses that are running your business, like they're integral to it. Let's say we are selling stationery, right? If we've bought stationery and we've not paid our supplier, that's a trade payable. But then an accrual, on the other hand, is, let's say you've not paid electricity, you've not paid for water. Let's say you've not paid for salaries and wages, even rent, I think you can accrue it. So the concept is the same. It's just that you try to separate so that we can be able to tell what exactly that expense relates to. The bank overdraft, I think we understand what a bank overdraft is. And then there is also your provision for doubtful debts. And your provision for doubtful debts are like, I think actually Nyamolo already explained this. Yeah. So you have already invoiced your customers, but then you know for a fact that this person is going bankrupt, this person is incapable of paying me. So to avoid misreporting, to avoid over-reporting your assets or how much you're expecting it, then you're just making a provision because you're just being prudent. So that is how the balance sheet comes in. I needed to elaborate on a few adjustments that you could make to your financial statements. No. Let's go through the profit and loss account first. And as we started, I said that your profit and loss, you can also call it your income statement, just shows you what is our profit. So anything that is income, anything that is expense only is what goes there. So that is why you'll have your sales. And of course, if then you sell something and then it's damaged, or a customer for one reason or the other returns it, then that should deduct your sale. And then now going down, you're deducting your expenses, right? And I'll be coming back here. Basically, this is your cost of sales. And your cost of sales, what it tells you is, so we made a sale of, let's say, 1,000 bob. We are selling stationery, right? So the cost of sales will show your expenses that are exclusive to making that sale, like not the incidental costs. For example, if we are selling our stationery, then the cost of sales just shows you what costs went into selling the stationery that we sold. So what was the cost of buying that actual stationery when you bought it? What were the incidental costs? Do you have your carriage inwards? I think this was explained. Do you have so that is, those are like the main costs, so that like without this cost actually you would not have made the sale. And then so that is how what makes up your cost of sales. And how you arrive at it is you will have your opening inventory. It will show that when we closed last year, then we had this much stationery to sell, but then we also purchased more. So it will show you like the opening, let's say when we opened we had 200, and then we've bought another 200,000. So basically that should show you that this is the stationery we have available to sell, right? But then you could also have made some drawings. And a drawing, when we're talking about drawings, a drawing can be in terms of the goods, but then it can also be in terms of cash. So if the owner draws goods, that is, they take goods for their own personal use, it is not sold, then you cannot reasonably declare that as a good that is available for sale, and that is why you must deduct it. So let's say we withdrew 1,000, right? And then also there is return outwards. We already explained this. And our return outwards also is we bought from a supplier, and for one reason or the other, we found that it was, let's say, defective. So we had to return it. And that is why you're deducting it, because you've returned it, so you did not incur that expense, right? And then you're adding your carriage inwards, because then the carriage inwards are now the incidental costs that went into you purchasing these goods. You had, let's say, to transport it from wherever your supplier is, from their warehouse to your own warehouse where you're actually selling the goods. So that is why you're adding it, because that is an incidental cost towards you acquiring these goods. So that is how you get your, oh yeah. So let's say to whatever, it doesn't matter really, it could be any number, but then you will deduct what your closing inventory is. And why you're deducting is, yes, we had our opening inventory worth this much, we bought some more worth 200k, but then at the end of the period there's still some goods that we purchased that we had not sold. So that is why you're deducting. And once you deduct, that is when you'll get your gross profit over here. And gross profit basically is your total sales. Okay, total sales, maybe you make adjustments for your returns that have been made. And then now you deduct the cost of sales, which we have said are the direct costs that, like, for you actually earning that income. And then I think another concept that we may not have mentioned is the aspect of other income. So you could have multiple income streams. Like nowadays, your what is it called? Your objects are not limited. Like you must not specify a specific thing that you're doing. Let's say we are doing a law firm. No. Let's continue with the stationery that we are selling. So if then our objects are, if you've seen a memorandum, or a memorandum, you would see that objects can go as far as I don't know how many, so, and any other. So even if your main business is selling the stationery, nothing stops you from building rental premises and renting it out. Nothing stops you from investing in whatever you want, from doing agriculture, from whatever really it is that you want. But then for the purposes of reporting, you should be able to pick one source of revenue that you're saying is your main business. So that if our business was for was for selling stationery, then if we end up investing in other things and having other diverse income streams, then we must declare it separately. That is why you have your other income. And your other income should not be adjusted with your cost of sales, because these costs are not directly related to the income that you have earned in the other income. And then having explained that, I think the expenses are pretty easy. Any expense that you incur in the running of your business now, all other ones that are not the cost of sales, then you deduct them. And then you should be able to get your profit or your loss. Until there, I hope we are okay. Let me just confirm. Okay, looks like we are okay. So that is our income statement. This is the template. So the odds are whatever information you'll ever be given in a question, in a trial balance, the odds are you'll never miss these main points. So I hope I've tried to explain how and why these are here. But then if all else fails, just you have this template, you can just master it. When you see something, you just remember that this was in the template of the income statement and go with it. What else am I missing? The statement of financial position, I think we already covered it. It should be okay. The only thing I did not cover is the retained earnings, which we are supposed to revisit. So what goes to your retained earnings? So once you do your computation for your profit or loss, you will have your figure here. Let's say it's 10,000. So what, or it could even be negative 10,000. Whichever it is, that is the figure that goes to your retained earnings. So once you're done with your profit and loss account, then the amount that you get as your profit or loss is what goes to your retained earnings. And if it was a profit, then it goes as a positive. If it was a loss, it goes as a negative. That is it for the template. Let me just see about the possible adjustments we can make to those accounts. We have already discussed about provision for doubtful debts. If it increases, then that is an expense. It means that I am ready to write off, let's say 2,000 more from the amount that I expect from my customers. If it is a decrease, then it means that I had already made peace with the fact that I would lose 200K. But then I ended up losing just 150K, right? Which means at the time when I had recognized it as a provision, I had already expensed it. And that is why now, when it decreases now, it stops being an expense, but it will be an income. Both of them, income, expense, that is in your income statement. And of course, it should then affect your accounts receivable, because the provision for doubtful debts is on the amount that you're expecting from your customers. And there's two ways to go about it. You can deduct that amount from your accounts receivable, or you can recognize it as a provision for doubtful debts. What I mean is, if you see our template here, there is the option of saying that I expect these debtors of mine will not pay me that much, so you just deduct it here. But also you could choose to not touch this figure so that it remains as it is. But then you recognize your provision for doubtful debts as a liability on your current liabilities side. That is on the allowance for doubtful debts. And then also you could draw goods. I think we already said this. So that then if you draw your goods, I am the owner, I take a few drawings from the company, from the business. Let me not limit myself to the company, but from my business. then it means that the cost I incurred in buying that good, that the goods that have been withdrawn, did not go into generating revenue for the company. And that is why then I need to debit my capital account. You see, your capital account is on the equity and liabilities side. So if you debit it, it means you're reducing the amount of capital. Let me take that again. I am Linda. I have contributed 100,000 as capital into the business, but then I withdraw from the company goods worth 10,000. 10,000, yeah, that is 4 zeros. So that is why I am debiting. Debiting basically would reduce the amount of capital I have to 90,000 now, because I have already taken goods worth 10,000 that was not used to generate the business. And I will credit my purchases account. And why I am crediting my purchases account is, we always say that it is just a rule, like for every income you credit, for every expense you debit. So I am crediting my purchases because at the time I bought it, it means that my purchases account was debited with this 10,000. But then once you draw that money, once you draw those goods, it stops being a company expense. That expense has not been incurred by the company because I have drawn it for my own personal use. That is why you're crediting it, so that you reduce the amount of purchases you have done by the 10,000 that has been drawn for personal use. And then you can also draw those goods as a donation. Donations are just expenses. So all that you'll be doing is just reclassifying, so that then so that this 10K now moves from being in the purchases account, but then goes to a donations account. So you'll debit your donations account and you'll credit your purchases account. But then you could also draw money. So if you draw money, then it means that money is leaving your cash or your bank. So definitely, then to reduce your cash in bank, because that's an asset, to reduce it, you have to credit. And of course, then you'll have to debit the capital account, which I already explained that, like, I am now reducing the contribution I have made to the company. That is why I am debiting it. Prepayments, I'll not belabor on that. Accruals, I'll not belabor on that. What I will do is now we will try to apply that to a question. So I had shared, I think should be December 2019, question 2. Let me just check if we are okay. Yes, please, Charity.
If I may, yes. Nini, I have two questions. One on the Excel sheet that you just closed, if you will kindly project it back, particularly on the issue of what happens to the capital when one of the owners draws by way of taking a product. Aren't you supposed to credit the equity account and then debit the asset account? Particularly either the cash account or the inventory account.
What I should have highlighted is the capital account is the same with the equity account. You use that interchangeably. So you were talking about the drawing of goods, yeah. So you're debiting your capital account, which means you deducting the amount of capital that has been contributed there, right? And then now you need to credit the purchases because you had bought these goods. When you bought them, you debited your purchases account because it was an expense. But the moment the owner draws it, it means that expense has not been used to generate revenue for the company. It has now been used for other purposes. That is why you need to credit your purchases account, so that then it shows less that amount, because it's no longer an expense for the company.
Okay, I think I'm fairly with you. My second question is on the treatment of just a minute. The treatment of revenue that hasn't been collected. You said we recognize it when it's earned. So
Yes.
doesn't that negate the need to have accounts receivable, because then accounts receivable are catering for such situations as giving out products that haven't been paid for yet?
So you see for you to have your accounts receivable, like an accounts receivable is not income. Like how do I say this? Um for you to have your accounts receivable, it means you credited your bank. Sorry. You credited your income and debited your accounts receivable. So that means that you already recognize the income in the profit and loss account. You'll never come back there again. You debited your accounts receivable. So let's assume you're done with this year and your customer comes to pay next year. So the moment they pay, that money that transaction no longer goes to your income statement, because that was an income for the previous year. What you will do is you'll debit the bank because money has come into your bank, and then you'll credit the accounts receivable, which means that you're deducting the amount that you are expecting from your client. So I will now, we are just doing a question on just drafting the same. So this is question 2 of November 2019, and we are being told that Peter was carrying on business, finds himself insolvent on the 31st of December 2019, files his petition for bankruptcy. So you have been given the following balances from his books. So this is an entire list of the trial balance. So perhaps it might help for you as you're reading through it, you sort of distill it and know that this goes to the balance sheet, this goes to the income statement, right? So we have capital, we have stock, which is as at the 1st of January, which is now our opening stock. You have your plant and machinery at cost, you have your motor vehicle at cost, and then you have your provision for depreciation for your plant and machinery, for your motor vehicle. And then you have your purchases and sales there, you have your returns. Because it's on the debit side and on the credit side, it means that one of them is return outwards and the other is return inwards. You have your wages and salaries, discounts, carriage inwards, outwards, postage and telephone, water, bad debts, all that. So what I find you should be able to do is, before you even start classifying this, before you even start drafting this, you should go to your additional information, so that you find out what adjustments, because most of the time the additional information would be adjusting the information you've already been given here. So so we can start with interpreting the additional information that we've been given, and then now we go back to drafting. So for number 1, we've been told that depreciation is charged at 10% of cost of plant and machinery and 20% of cost of motor vehicles. So 10% of cost of machinery, right? You have your machinery there, is 250K. So 10% of it should be 25,000. So we can have our note 1 there, where we're being told about our depreciation, and we're being told that it's at 10% for machinery. Let me just call it PPE. For our machinery, we've been told that it's 10% of 250,000. So you get your 25K, and for your motor vehicles, it's 20%, and it's 20% of 80,000. So for motor vehicles, then it's 20%. Let me just say 0.2 times 80,000. So that is 16,000. you're done with your point with your additional information number 1, which means that then you need to, this is the depreciation expense, so you need to debit your depreciation expense in the income statement and then credit your assets, which means that you're reducing the value of your assets. We go to additional information number 2, and you're being told that the closing stock was at 31st was 22,500. So your closing stock was 22,500. The next one, you're being told that the accrued rent is 3,000 and prepaid rates are 1,000 shillings. So accrued rent, so you have accrued some rent, right? So and the accrued rent is an expense. So you need to debit your rent expense and then credit your accruals. So we can just do for point number 3. Since we are accruing, then your debit, let me skip that and have a debit and credit there, right? Yeah, so we have our rent. Our rent is worth 3,000 shillings. So we are debiting it because it's an expense, and then you have your accruals as 3,000 the same because of the double entry. So that is your additional information number 3. There should be a second thing. You're also being told that prepaid rates are at 1,000 bob. So you've already been given your prepaid rates here. You have your rent and rates here, 15,000. But then you're being told that of that 15,000, then 1,000 is prepaid, right? So you're taking your 1,000 shillings there as prepayments, which is 1,000 bob. And then I think it's rates. You're crediting the expense for rates because then that means that your expense should be less than 1,000, which is a prepayment because it relates to that subsequent year. We go to the next one. We have an outstanding electricity expense of 600 bob, which means that that electricity expense has not been paid, right? So that is an expense. So then you're debiting. That is number 4. That is an electricity expense. That is it's 300. No, it's 600. Yeah, so it's 600, and of course you're crediting, that is also an accrual because it's still outstanding, you've not paid for it, so that is why you're crediting your accrued expenses. And finally our provision for bad debts is to be increased by 300, right? So there should be an increase, number 5. There should be an increase in our provision for doubtful debts. Let me just copy that, which is an expense. And of course, you're crediting that with your now the provision that comes here. And as you would recall, you can do it either way. You can credit it here or you can reduce your accounts receivable. The net effect would be the same. So yeah, so this is the expense, the increase, so that's 300, and then you credit it against the obligation, which is 300. So we are done with our additional information. So what we need to do now is to, the question wants us to prepare an income statement for that year and also prepare a statement of financial for that year. So just allow me to just paste the template here for in the interest of time. And there should be, and this is our SOFP. This is just the template. We are just pasting it there so that we fill it for in relation to that question. So we can start with doing our profit and loss account. No, it's here. Yeah, so we can start by looking at our information. And if you go back now to your trial balance, then the first capital goes to the In fact, by the way, in the interest of time, as we move, will allow me to be filling where it's necessary. So our capital is 250K. Capital is in your balance sheet. So let me just go to the balance sheet and paste. I hope it's 250K. I forget. Yeah, 200. I hope so. We'll find out. But then for you for like in the exam, of course, it's better to be more systematic. So our stock, our opening stock, yeah, as at January was 25K. So in our profit and loss account, or I'll be losing you. If I'll be losing you, just interrupt me. But if I'm not, then let me just fill it up. 25,000. And then after that, you have your plant and machinery at cost, and your cost is 250,000, right? So here, our plant and machinery there, the cost was 250,000. What I may not have explained, what I neglected to explain is that what I failed to explain is our accumulated depreciation is the depreciation that has been accumulated over the past years, over the previous years. So for our plant and equipment, then our accumulated depreciation is this column here, the 20,000. So that means that up to the beginning of this year, the accumulated depreciation on the plant and machinery was 20,000. So that is our accumulated depreciation there, 20,000. And then in addition to that, we have also charged depreciation for this year. So you'll just go to your additional information there. For plant, you just add that. That is now our total depreciation, and our net book value then should be our total cost. You deduct the accumulated depreciation, you get that. And then we move on to our motor vehicles. Our motor vehicles is 80,000. So that is our cost there, 80,000.
Hello, Chiri.
Yes.
I feel like you're moving a bit fast.
Okay.
Please go back to depreciation.
Okay. The computation or this?
Yes.
Here.
You are able to read it back to the question whereby to remember the accumulated depreciation was 20,000. I thought, yes, 20,000. I thought our depreciation goes to our income statement and not our balance sheet.
So this depreciation here is okay. The depreciation for the year is an expense. It's an expense for the year, and it would be a debit. When it is a credit, it means that that is the accumulated depreciation. It means that as at the beginning of this year, before we charge depreciation on our assets for this year, actually the value was the cost 250 minus 20K. That is why your cost is a debit, your provision is a credit. That is the net book value before you charge the depreciation for the year. And now the depreciation for the year now would be a debit. So that is the expense for this year. But when it's a credit, that is the accumulated from past years.
So that means it goes to the balance sheet?
Yes. The accumulated goes into the balance sheet because you're basically saying that we bought it at 250. We bought it in 2014. Since 2014 until now, it has depreciated with 20K. Sorry, yeah, it has since 2014 until last year, before we depreciate for this year, it has depreciated with 20,000. So that is why we are deducting our accumulated depreciation here, both for past years and then adding here this year. If haungetaka ku adjust with your accumulated depreciation from years past, then you would not be using your cost here. You'd just be using the net book value as at the start of the year. Sawa?
Sawa.
Yes. So our motor vehicles is 80K and our accumulated is 16K. 16,000, and then I add the depreciation for the year which we have not charged yet, which is 16,000. So that is your that. So far tumefika kwa provision. We go to purchases and sales. These are things that goes into your income statement. So if it's a debit, that means that is the purchases, that is the expense. If it's a credit, that is the income or the sales. So 360K is the purchases. So if I come to our template for our income statement, then our purchases here, wait, this was 25K. Sorry, I should have put it here. This is the template. 25,000. That was the opening stock. We had already seen it, and then we're being told that our purchases is 360,000. After that, then we move. Our sales is 600,000. So our sales here, right, is 600,000. Let me just do that. Okay. We are done with the purchases and our expenses. And then we have the returns, right? So the returns that is on the debit side because is the return inwards. It is the return inwards because it is deducting our sales. You see your sale here is 600K. Ikiwa a debit, it means that 40K was returned to us, so we need to adjust our sales with 40,000. So let me do that, Papa. Minus 40,000. And then on the debit side, then that is a return outwards. So that is affecting our cost of. I'm not certain where I got, but I don't think I got muted quite a long while ago. So we were at the 20K now, the one on the credit side. The one on the credit side means that it's a return outwards because it is deducting the purchases that you have made, so that then it is 20K less. So our return outwards then should be deducted from our cost of sales. Yeah. Alafu, the next one is we have our wages and salaries. That's an expense. I think this is a no-brainer. So that is 60K. I hope I've not forgotten. 60K. 60K. Yes, it is 60K. And then you also have discounts again. When it's a debit, it means that's an expense, right? And that means that that is a discount that you have allowed. Like you invoiced someone, but then you have allowed them a discount. So you're losing money on your side. That is why it's an expense and it's a debit. So this is your discount allowed. If it's a credit, then it's an income for you. So you have received it. So it's a discount received. So the debit side, of course, should go to your expenses, which is 5,000. So that is your discount allowed there, 5,000. And you also received your discount of 4,000, which goes to your other income there of 4,000. After that, then we got to, after discounts, we have our carriage inwards, and we're being told that our carriage inwards is 2,500, and that should also affect our cost of sales. So that is our 2,500. The next one is carriage inwards. You have carriage outwards. Carriage outwards just goes into to the expenses here. So that is 3,000. And then the next one is postage and telephone expenses, that is 7,500. Hiyo haiko kwa the template, so we can just add, insert postage and telephone. And how much is it? Our postage and telephone is 7,500. Sorry, yeah, 7,500. After that, then you have your water and electricity, which is 8,600. 7,600, and that is our water and electricity. Turns out we do not have water and electricity as well. As you're doing this, you should be remembering that you had the additional information. So whenever you're dealing with an item that was adjusted, then remember to adjust it. For example, like this, we have our water and electricity, which is 8,600. But then there was something touching on it for the additional information, which we needed to expense more electricity by 600 there. Next, you have your bad debts written off, which is 1,500. I think we have it here. And then the next one you have is your general expenses, 8,500. Let me put it up for other expenses, 8,500. The next one we have is provision for bad debts, right? That is coming to our balance sheet here. The provision for bad debts, right? So 1,000. But then also you should be able to recall that we had something touching on it there. So you credit it, you add it with that much. And I think, have we touched increase? Oh no, not yet. But we had a note for that, so I can just adjust it. Sahi. Our increase is there with 300. That is from the additional information. We are close to the end. So rent and rates, you have 15K. So your rent and rates looks like I do not have that in the template as well. So let me insert it. Rent and rates, which is 15,000, is it? Yes, it is 15,000. And then in your additional information, then you had something touching on it. You had rent, the expense, you were debiting it there, right? But then also you were crediting it in this one. Yeah. So that is it. And then after that, then you have your accounts receivable, which have not been adjusted. So you put it as it is, which is 55K. The next one is accounts payable, which is 46,400. That was also not being affected. Your cash in hand is 6,000. Your cash at bank is 30,000. So 6,000 here and 30,000. Are we done? Yes, we are done. The only thing we need to adjust here is the accruals, which are in our additional information, where you had accrued your rent and also accrued your electricity there. And of course, we also had prepayments from the additional information there. Additional information, where is it? Prepayment, yeah, there. I 1,000. So I think we are done. So let's find out if so we have our sales, we deduct, you get that. We didn't have any drawings, so I can put a 0 there. So HAPA is the sum of that. And then this, you're just adding the total goods that you have there, plus, sorry, the total cost plus also the carriage inwards to get that. And then you're supposed to less your closing inventory. And our closing inventory, we had been told, was how much? Our closing inventory was 22,500. Sorry, I need to deduct it. So then what I get is that plus that, right? So this is our total. This is our total cost of sales. And to get the gross profit, again, we just said it's income, right? You deduct your expenses there. You didn't have any other income, so your total other income is just 4,000. And then your other expenses, let me just delete that and delete. Oh, no. Depreciation is an expense. Sorry, I forgot to include that. And our depreciation was 25K plus 16K. Yeah, so our total then expense is equal to sum of all this. So then our profit or loss, right, should be the gross profit that we have there. You add your other income, and then of course you deduct your expenses. This is we got that. Oh, actually this 25K, this should have been some all the way from the 25K down. Yeah, so we are done with our income statement. And now the amount that we have got here as our profit, remember we said it would go to our retained earnings here. So you will just transfer that 66K as it is there. So we add and see. Delete that, delete, no, don't delete that, but delete this. Some. We didn't have any inventory from our closing inventory actually was 22,500. Yeah. So then our total here is our total current assets, just summation of that. So our total here is that plus that. Your current plus non-current assets. Yes.
Sorry to interrupt. Before you proceed, I thought that 22,500 we had taken it in our income statement.
Yes, we had. Let me just explain that one more time. Okay. Why it came to your income statement. Remember, you are deducting it. Basically, what you're trying to say is to as at 1st of January, let's say our inventory was worth 100K. In the course of the year, we have bought more goods for sale worth 5 million. But then at the end of the year, bado tumebaki na another 1.5 million, right? So basically you're saying then that the only logical explanation is the goods that we have sold should have been worth what we had at the beginning of the year, what we bought, deduct what was remaining at the end of the year. That is why you're just deducting it here, so that you just do the total goods that you had, and then you deduct what is remaining, because that you have not sold, so that is not a cost for that year. But then when you're coming to your balance sheet here, you're including it here because these are your assets. They are our goods. We are going to sell them. We own them. So that's an asset to us. That is why we are doing this. So we didn't have anything there. Our total here, let's find out if it balances. If it does not balance, good thing about accounting is you'll just know if you're wrong. 50, our total there, plus that. We are missing how much? We have 367, you deduct 366. We are missing 1,500. That I'm not sure where it's from. 1,500. Did we increased our provision for doubtful debts? What is this? Oh, I put the provision for doubtful debts in the wrong place. Yeah, there should be 1,300 here. What else did I put in the wrong place? I could have put something else here. We have our capital, that's okay, that is okay. Our trade payables is 46. Oh, it is 46,600, not 46,400. Yeah, so that is, so now we have drafted our income statement and our balance sheet. So we are done with this question. I hope we've been together, but we have another topic to cover. So since I do not see a question, I will just move to the topic on cash flows. Let me close this. Ken Nyamolo, yes.
Yes, Linda. Thank you for that good work. And I would just sound a warning to the class members. You've seen that last bit where you are looking for that difference of 1,500. In an exam situation, you may not need to go looking for one sheep or one goat that is lost and you leave the other 9,000. It is only in the Bible where you are told to go looking for the one that is lost. So once you've posted your entries correctly, you are competing against time. So then, tosheka na ile umepata, move into the next question. At times, you might realize, you may think that you've done it the right way, just for 1 mark, and you end up spending the next 15 minutes. If you were to post the next question, you would have gotten 7 marks instead of chasing that thing to balance in an examination situation. I think it is important that we take that principle of leaving 99 sheep kwenda kutafuta moja is only applicable in the Bible. In accounting and examination situation, for ground mambo ni different. Thank you.
Thank you, Nyamolo. Thank you. By the way, I doubt marks for balancing are that much. So ikikata, don't force it. But allow me to move into cash flows. This should be shorter. And okay, so let's start on the statement of cash flows. And Basically, what the statement of cash flows does for you, it shows you how literally cash flowed, like how much money did we receive, how much money left us, so that how much money do we have now. The concern here is liquidity. You want to be able to, you don't want to be declared bankrupt. You want to be able to meet your obligation as and when they fall due. So you may find that perhaps, yes, you have money, you have assets, you could own Kenya in its entirety, but all that is just liquidating it is a problem. So that is why you do your cash flows, so that you see, do I have enough cash? Perhaps do I need to take a facility or such a thing? Do I need to relax my my credit terms with my customers? Do I need to negotiate better terms with my suppliers, so that then you can be able to have cash and run your business? So that is the logic behind having a statement of cash flows. And the categories in that statement could be from operating activities. Basically, operating activities is the cash that is going into the main operations of your business, right? How much sales have you made, and how much have your customers paid you? That's an operating. How much have you paid to your suppliers? Like the main things that are helping you run your business. How much expenses are you paying? That is what goes into your operating activities. On the other hand, for the investing activities, what investments have you done, right? Have you bought property? Have you bought shares? So what investments have you made? And then, of course, you can have financing. So did you see that you are running out of money? And now, did you decide to issue more shares, so that now you're raising money through shares issue? Did you decide to take out debentures? Did you get an overdraft? Did you get a loan? So that is what from financing activities is about. And the interesting thing about cash flows that I think I should point out at this stage is, for the cash flows, it does not matter pesa ni ya nani. A good example is from financing activities. You may receive a loan. A loan, we understand it to mean that hiyo pesa si yetu, we owe it, we need to pay it back. But then it will be an inflow because you have that money that is available for you to use. So so I think that is the idea I needed to explain. For cash flows, it does not matter if you own the money or not, so long as the money is available to you. Another example I could use is for accounts payable, right? You may find that you have more, like your suppliers are letting you take a lot of stuff on credit. Yes, you owe them, but in a way they are financing you. They are financing you because you have not had to part with money to pay for it. So that would also be an inflow. But as we get into the methods, you should be able to see how that works. So how you can prepare your statement of cash flow: you can have your direct method, you can have your indirect method. And a few things to note here is, for most businesses, kwanza tuanze na interest and dividends. For most businesses, unless you're a financial institution, so that your income is actually from interest, you would probably get your interest from as an investing activity. So that, let's say we did a fixed deposit and we got an interest, so that's our inflow, our cash from investing. But then if it's specific to a financial institution, then you would know that their income APO is interest, so it will stop being a financing activity, but it will be an operating activity. Taxes, of course, it can never be an inflow, it's always an outflow, and it is mostly related to your operating activities. Have you paid income tax on the income that you have earned? So most times you would put it in your operating activities, unless then you can be able to ascertain with certainty that this specific tax is in relation to our core business, and then perhaps this tax is on the interest that we got from our investing activities. Then you can separate it. But most times, and it's very acceptable, go with it ikiwa kwa operating activities. And finally, I should point out non-cash transactions. Again, as we said, Hapa, you're just concerned about how cash is flowing. If there was no cash flowing in this transaction, then that thing should not even get near your statement of cash flow. An example, you sort of acquire an asset, but then you don't pay it. Let's say it was secured, right? Yeah, let's say it was secured, so that you're just saying that take this land, right? Take this land, but I'm not like paying you. I am telling you, take this land and then you will pay this loan for me. Then that unaona hakuna money changing hands, so that would not feature here because it's an uncashed transaction. You could also decide to buy a company there, but then you've not paid them money, you've issued them with shares. So technically, money has not changed hands, so that would not feature in your statement of cash flows. And also, if you convert your debt to equity, money has not moved hands again, so that would not go there. So you should be able to tell that it's literal money, not an obligation, not a right, but literal cash that is moving. So we had said that you have your direct method and you also have your indirect method. So I will start by taking us through the direct method. This is also a template. I will try to, I think actually I have already tried to explain. I have already tried to explain, but if all else fails, just master this template and know what goes where. But I'll try to explain it. So we start with our direct method, and our direct method, you're just dealing with okay, no. Let's just go through the direct method, and then when you get to the indirect method, you will understand why it's different. So from your direct method, then you will just be taking how much money have you received from your customers. That's an inflow. You've received money. How much have you paid? That is an outflow. How much have you paid to your employees? That is an outflow. Yeah, like how much cash have you generated generally from operations? That's an inflow. How much have you paid as interest? How much have you paid as tax? That's an outflow. And then hapa nikisema extraordinary item, this could be anything that is not in the template, but anything that you feel relates to relates to you running the business. And then you're investing, I think I already explained that. So if you purchase property, if you purchase a plant, equipment, or any other fixed asset, then that is an outflow. You've paid out money to get that, so you've lost money. So money has moved out. That is an outflow. Well, I have been assuming that when we see brackets, we know that that's a minus. I hope we know that. Yeah, so that is an outflow. And then the ones that don't have a bracket, that's an inflow. So that's a plus. So if you sell an equipment and you get some proceeds, then that is also an inflow. If you receive interest from your investment, if you've invested in shares and you receive dividends, that's an inflow from your investing activities. You also have your cash flow from financing activities. So there you're trying to raise finance. So have you taken a loan? So that's an inflow. Have you issued shares and like people are paying for it in cash? Then that is an inflow. But then also, yeah, have you paid out some dividends? Have you paid out some dividends? Because now you see dividends is directly linked to the issuance of shares. You issued shares, so that was a financing activity. So you're paying dividends in relation to that financing activity. That is why it's an outflow. And then also, if this is a finance lease, yeah, a lease is some sort of a in a way a financing. So then, if you're paying out, or even if you're paying like principal on your loan, then all that is an outflow and it's from your financing activities. So what you will do is you will just add all inflows and outflows from each category. You get whether it's your positive or your negative from operating, and then you will also get it from your investing activities, and then you will also get from your cash, right? From financing activities. You will get your total here. That is where you have your net increase in cash and cash equivalents there. And then now you need to adjust. What you're saying is, within this year, this much has moved. That is where you have your net. And then your cash and cash equivalents at the beginning, you're saying, so as at the beginning, we had 1 million. And then during this entire year, the cash flow, the net of it movement, we have 3 million. So our total cash and cash equivalents at the end of the period then should be the 3 million plus 1 million, you get 4 million. Something else I should point out, and I am not encouraging you to, look for the lost ship, but if you do your statement of cash flows and the balance does not tally with what is in your balance sheet as the cash in hand and cash in bank, then you should be a bit off. So you can revise it, you can play with numbers if you're good at permutations. I'm just putting it out there. So that was our direct method. So let me try to distinguish it from the indirect method. I do personally prefer the indirect method, but then also sometimes the instructions will be very specific, or the way you'll be given the information, it would not allow you to use it. So it's good for you to know both of them. So for the indirect method, you're already starting. You will realize if you use your direct method here, if you take your cash receipts from customers, cash receipts paid to suppliers, this is basically you just saying the income or the money you've received from your customers less the amount that you have paid out, which basically is giving you the profit in a sense, right? And that is why for the indirect method, you're not going through the trouble of calculating all this. You're just taking the profit that you already have from your profit and loss account, which means for you to use the indirect method, the question would have already given you the net profit. So what you're doing then, you're just like this has already been worked out for you so that you already have your profit. So wewe unaanzia kwa profit. And then now you need to adjust. I should have specified here. These are sort of non-cash items, because you would find that to depreciate, when you're computing our depreciation, money really doesn't change hands. We're just reducing the value of our assets. So that is why you're adjusting, because for depreciation, which you had already expensed in your profit and loss account, like you already deducted it for expenses zako. So for indirect method, you're adding it back, because you're saying that to get this net profit, I had already deducted my depreciation. But then it is not a cash item. So for the purposes of my statement of cash flows, then I should be able to add it back, because I shouldn't have deducted it in the first place, because it is not a cash item. Now I have already explained that I have already explained that for depreciation, and the concept should be the same for your amortization. Amortization is basically just depreciation, only that you use it for intangible assets. Yeah, you have software, you have goodwill, whatever you want to amortize, whatever is intangible and you want to depreciate, you just change it's a matter of semantics, really. You also have your foreign exchange gain or loss, that is not a cash item. So you have also, so you're adding it back or deducting it depending on whether it was a gain or a loss. So actually with my stroke, if it was a loss, you'd be adding it back. If it was a gain, you'd be deducting it. And then your investment income or loss, you'll be adding it back, right? Because you'd be adjusting for that, because you already have a category for investment hapa chini. So you're just saying that this is in the wrong category. That is why I need to adjust for it, because itakuja hapa chini. Also, you will have your interest expense, which you're adding back, because for this template, it should just come here, because now you're trying to get the actual figure before adjustment for interest and for income tax, right? So you're adjusting it there to get your operating profit before working capital. And then now, so that is how you get your operating profit before working capital. But then you also need to make adjustments for working capital. What you're saying, I will contradistinguish it with the direct method one more time. If you are saying that you have received your cash from customers, what it would mean is, you see, the money that you're receiving from your customers could be the sales that you have made for this year, but it could also be the accounts receivables you're expecting from prior years, and your customers are paying it now. So in a sense, it commingles. So if you wanted to get your cash receipts from customers, you would do your opening. Allow me to use AR, that's accounts receivables. You would add, right, the sales for that year, and then you would subtract the closing accounts receivable. Same for suppliers, and only that now okay, let me remove the equals. Yeah, so this is how you would get it, so that you're saying, I was expecting this much from my customers, and then I have received this I have made this much sales, but then at the end, I'm still expecting this much from my customers. So the net effect of it should show how much money you have received from your customers. So when you come to your indirect method, right, your sales zilishakuwa factored in hapa. That is why your sales are not factoring in your computation for your working capital. So you're just interested in the movement within the debtors. So you're saying, at the beginning of the year, I was expecting this much from my creditors. From my debtors. Let's say at the beginning of the year, you're expecting 400K. At the end of the year now, you're expecting 200K, right? Which means it may reduce. If it has reduced, it means you have actually received the net effect, which is 200K from your debtors. The same goes for your inventories. The same goes for your trade creditors. So once you finish adjusting for that, that is how you get your cash generated from operations, which is cash flows from operating activities. And then now your cash flows from investing and financing activities remain the same as the direct method. So what changes really between these two methods is how you arrive at your cash flows from operating activities. Yeah. So we have, I'm just going to check if there's a query, if there's an addition. Yeah, Nyamolo, please.
Sorry, there is an older hand.
Okay then. So that is the idea behind the statement of cash flows. Again, we are going to do a question on it. So this is question 3. Yeah, question 3. Yeah. So we're being told that Munyao Advocate has this balance sheet as at 31st of December. So there goes his fixed assets, depreciation, the work in progress, debtors, cash, all that, and it has been financed by that. So our additional information hapo unaambiwa that the drawings were made in cash, which means that that should affect our cash flows. And then we are being told that there was no disposal of fixed assets. So then we are being told to draw a cash flow statement. Again, in the interest of what I needed to point out is, for this then you will have to use your the indirect method, because from the information that you have, right, you cannot possibly get the basic information to do your, like, you cannot ascertain how much was received from your customers, blah blah blah. So from the information that you have received, then the only way you can work it out is using the indirect method. So in the interest of time, allow me to paste the template here. Okay, so you will remember then that tukifanya our balance sheet, our net profit was going to the retained earnings, which is what these ones are calling the profit, right? And we are doing it as at 31st of December 2015. This is the column of 2015. So it means then our net profit for that year was 3,600 bob. So let me take that there, 3,600. And then we now need to do adjustments for depreciation, right? And our depreciation for the year, right? It's telling us at the beginning of the year, your depreciation was 2,000. But then at the end of the year, you accumulated, I'm sorry. At the beginning of the year, your accumulated depreciation was 2,000 here. At the end of the year, the accumulated depreciation was 2,200. So it means within the year, the movement within the depreciation account was 200 bob. So you're taking your 200 bob there. You do not have any amortization. You do not have any forex. In fact, this was a bit easy. That is also a zero. So then your total before working capital is just the, let me do just some escape. Let me do some. Yeah, so this is your cash flow from operating activities, right? And then we need to see whether there was an increase or decrease in debtors. So ukikuja kwa your debtors, you're seeing that at the beginning, you had 1,200. At the end, you have 1,000, which means that your debtors have increased. Have reduced. What does that mean? It means I have received 200 more from my debtors. That is why I am expecting less from them. If I have received 200 more from them, then that is an inflow. So it comes here as a positive 200. And then I can rename this for the purposes of our question to work in progress. And for my work in progress, I am saying at the beginning of the year, right, my work in progress was 1,000 bob. But then as at the end of the year, my work in progress is 1,500 bob. So I have actually invested 500 more in work in progress. I have spent 500 more in work in progress. So that is an outflow. So I'll do a negative 500 there. The next one is the movement in creditors. And we are being told, what I'll do is I will just, I'll just merge them because the idea behind creditors and accruals is the same. So what we are being told here is at the beginning, we were supposed to pay 1,600. At the end of the year, we are supposed to pay 1,400, which means we have paid 200. We have paid, cash has left our hands, right? So that is an outflow of 200 bob. Minus 200. Okay, let me not be, let me insert. I can just do movement in accruals for better clarity. Good. Yeah, so for the accruals then at the beginning, we were supposed to pay 200. But then right now we are supposed to pay 300. So in a sense, right, someone has financed us, like they have allowed us to sit on 100 more of their money, right? So that's 300. Sorry, it's 100 bob. It's 100 bob. So you get your total, which means that your total cash generated from operations, right, is you have that, and then you add this. For the purposes of our question, hatujapewa any of this. In fact, I should even delete. So our net cash flows really is, actually, let me do this. Just this alone for that category, and then now our total is that plus that. So we go to our investing activities. Have we purchased anything? Let's find out. So our fixed assets zilikuwa at the beginning zilikuwa worth 5,000. But then at the end, it's now 6,000. So it means we have bought an asset worth more assets by 1,000 bob. So then this is an outflow because you have paid money to buy it, right? And you're being told for additional information, there was no disposal. So this was just purely a purchase. After that, so you have not sold anything, you have not received any interest, you have not, let me delete that. So our total from investing activities is just the negative 1,000 bob. We go to financing activities, right? So we can start by the capital. And our capital may move. At the beginning, we had 2,500. At the end, we have 4,500. That means that our owners, our shareholders have injected 2,000 more into the business. So that is an inflow, right? So you just add the 2,000 hapo. We have not taken any loan. We have not done anything else. But what has happened, right? There is an issue on the drawings. When you remember, the drawings were made in cash. And our drawings at the beginning of the year, zilikuwa 1,000. At the end of the year, they're 2,700. That means that our owners have taken 1,000 shillings, 1,700 shillings more from the business. So that is an outflow. Money has left the business and gone into the owner's hands. So that is 1,700 there. You get your total of 300. So our net then is how much? It is 3,400 plus what we have for investing negative 1,000 plus the 300 that we have here. You get 2,700, right? And yeah, now I should have renamed this to, this was drawings. Drawings by, yeah, let's just call it drawings. You already understand what drawings is. Yeah, so yes.
Yes, sorry to interject again. So how are you getting 2,700? Let's go back to that, Nini.
Actually, before we go back there, I need to point out something here. Unaona, when we were starting with our profit before our net profit before taxation, right? So what happens to your retained earnings over the years? Like profit ya last year ulipeleka kwa retained earnings, the other year ukapeleka kwa retained earnings, the other year ukapeleka. So at the beginning our retained earnings was 3,000, and at the end it was 6,000. It was 3,600. So hapa it should have gone as 600, which is the movement for the year, and not the entire 3,600, because that's a historical from Kitambo. Now, getting back to you, Purity, how I got this figure, right, is for you to get your net increase in cash and cash equivalents for the entire year. It is how much is the net of what you got from operating, how much is the net that you got from investing, how much is the net that you got from financing. So to get your net increase, you're just adding like the total that we got from, let me just delete and do that again. The total, because we said we have 3 categories. You have operating, investing, and financing. So what total did we have for financing? 800. What total should be plus? What total did we get from, sorry, backspace, delete, in fact, escape. Sorry, what did we get from operating hapa? Yeah, total your operating it is 400. What total did we get for finance investing? It's negative 1,000. What total did we get from financing? It's that, right? That's 300. And then now you're doing how much was our cash and cash equivalent at the beginning of the year. So if you check your cash and bank hapo, your beginning was 1,100. So it's equal to 1,100. So your cash and cash equivalent at the end of the period then should be what is the net movement in the year plus what did we have in the beginning of the year? You have 800, which should be how much you have at the bank at the end of the year. If it is not, then you may want to double check, but don't spend too much time on it because I think the marking scheme is on every correct entry and not the right final answer. Purity, did you get that?
Sort of. Thank you. Kinda.
Okay, let me just say that again. When we started with our statement of cash flows, we said we have 3 categories. You have operating, you have investing, you have financing. How much cash you have is what's the total from operating plus what is the total from investing plus what is the total from financing. So when we came here, we had worked out those that are relevant to operating, tukapata total yetu ni 400. What was relevant to investing, tukapata total was negative 1,000. What was relevant to financing, tukapata the total was 300. So for you to get the total cash flows, the net movement for that year, you're doing a summation of the totals from each of the 3 categories of cash that we have. And then now you're saying now, just for this year, the net movement is 300. But then at the beginning of the year, the money that we had was 1,100. So you're summing it up, which should be able to give you what you have as you speak. And then I had seen a hand, a guitar, Emily.
Yes, Piri, if you could kindly do a recap on the accruals part.
Sawa. In fact, I think the timing is good. I am done with what I was to discharge, so we can feel free to just ask questions, not necessarily in relation to what we have done. So the thing about the accruals, right? An accrual is just an obligation. Like, what do you owe your supplier? Like KPLC, right? They have invoiced you for electricity for this month. You have received the invoice, and the invoice is an expense for you, but then you have not paid it yet. So it means that you're accruing it. Like the amounts owing to your suppliers is accumulating over time, so that then you're supposed to pay it later. So that then it will go as an expense because the invoice umepewa na ukaambiwa this is electricity for the month of February 2022. So that is an expense for February 2022. You have recognized that as an expense in your February 2022 expenses, but then you have not paid it. So basically the accrual just shows you that I have this obligation towards my supplier, so I should pay that. Emily, are we okay?
No, the explanation to that part is okay. My issue comes on as to the recording. Because
okay.
it was at 200. Okay.
Oh, you meant in relation to the question that we have done?
Yes.
Sawa. So ndo here accruals hapa, so I can just go to the question. So this column is 2014, this column is 2015. We are reporting for 2015. So what we are saying is, at the beginning, in January of 2015, because you see, ukipewa 2014, this means this is what they closed. That was 31st of December 2014, which is basically the 1st of January 2015. So you're being told that at the beginning of the year, the amount that you are owing, the amount that you're supposed to pay your supplier is 200. But then at the end of 2015, the amount you're supposed to pay is 300. There is an increase of 100K. Sorry, yeah, actually 100,000. That is true, yeah, because to truncate. So there is an increase of 100 bob, which means that your suppliers have allowed you credit of 100 bob more. You have not had to pay 100 shillings more. Like, had you paid it, it would have been an outflow. But then since they've allowed you credit terms, it is in a way an inflow to you, because you're still sitting on that money. So it's still money that you have. So it's an inflow to you. That is why we recorded it as a positive, because is it a positive? It may increase. Yeah, it's an inflow, which means like they've sort of financed us. It's like tumekwambia take this 100 bob. That is why it's an inflow. No, we are not on Chrome.
I have a question, Chili.
Yes.
I'm not getting the main difference between accruals and accounts payable, because even with accounts payable, you've taken goods on credit. I want to imagine. Yes. What's the difference?
Okay. So, in fact, since we are not in a hurry, let me just try to break it down visually. So, I will use the example that I used when we were starting. Yeah, we are in the business of selling stationery. Our main business is stationery. So for us to actually run this business, we need to buy stationery and sell it. So accounts payable would go to the amounts owing in relation to expenses that are central to the business, so that if we have not paid our supplier our stationery, which is what we are here to do, like the main business that we are doing, then that is an accounts payable. But then if we have not paid other now, what do I say, incidental costs, like costs that are secondary to us running the business, like we must hire out premises and pay rent to accommodate the business of selling. We must connect electricity, we must connect water. So you see the other incidental costs that zina facilitate the running of the business. That is what you accrue. But then you're right, the concept is the same. I believe no one should be able to penalize you if you were to lump them up, but maybe it's not that safe. But the concept is the same. It's just separating so that you know which is integral to the business and then which one is secondary and secondary to the business. That is why we have them both, but the accounting treatment is the same.
That's very clear. That's very clear. Thank you so much.
Aye, sawa sawa. Any other query? Yes, I am sharing the templates immediately. Marvin, I was worried about the time, but if I lost you, you can just raise an issue. Yes. The closing of 2014 is basically the first. Thank you, Nyamolo. Okay, so it appears that there's no other issue. So allow me to share this. And then tomorrow we'll be having Nyamolo, and he'll now be moving to partnership and advocates account at the same time. So see you tomorrow.
Bado akili iwekwe free gear, free mode, free wheeling. No panic. Thank you.
Yes, yes.
Thank you, Linda.